Picture two people. Same office building, same city, same industry. The first person earns $88,000 a year. Walk into their life, and you'll find a car note that resets every 4 years, 3 credit cards carrying rolling balances, a lifestyle that expands quietly every time their paycheck does, and a checking account that looks healthy on the 1st and panicked by the 25th. This person earns a real income. They work hard. They are not reckless, but they carry $34,000 in consumer debt and haven't been able to save a meaningful amount in over 3 years. They tell themselves next year will be different. Next year, the number goes up. The second person earns $61,000 a year. Walk into their life, and you'll find a used car they own outright, a single credit card paid in full every month, a savings account with 8 months of expenses sitting quietly in the background, and a brokerage account they've been adding to consistently since they were 27. There is no debt attached to their name except the mortgage they're slowly paying down. Their paycheck doesn't feel tight because none of it belongs to a lender before it belongs to them. Same city, same decade. The person earning $27,000 less has more financial freedom, more options, and more peace than the person who out-earns them by a significant margin. This isn't a story about income. It's a story about what happens when money arrives and where it goes before you ever get a chance to decide. Because here's what most people don't realize. Debt doesn't just cost you money. It costs you every decision you were supposed to make with that money. It quietly redirects your income away from your future and towards someone else's. And the rules that change that, the ones that finally make your income actually yours, almost nobody teaches them directly. Today, that changes. If you're finding this valuable, make sure you're subscribed to Begin Success. We break down the money rules that actually move the needle, and you don't want to miss what's coming next. Before we get into the rules, there's a concept you need to understand first. Because without it, the rules won't fully land. And with it, every financial decision you make from this point forward will look completely different. Here it is. Debt doesn't just cost you the payment. It costs you the investment. Most people think about debt in monthly terms. The car payment is $480. The credit card minimum is $150. The personal loan is $220. Added together, that's $850 a month going to lenders. Uncomfortable, but manageable. Life goes on. That's the first cost. Visible. Calculated. Accepted. But there's a second cost that almost nobody accounts for, and it's the one that actually determines whether you build wealth or just cycle through paychecks for the next 20 years. That $850 a month, redirected into a broad market index fund instead of debt payments, compounded over 25 years at a historical average return of 7%, becomes approximately $685,000. Read that again. The same dollars. The same monthly amount. The only difference is where they went. One path handed that money to a lender in exchange for things you've already consumed or forgotten about. The other path turned it into a number that could retire you early, fund a business, or eliminate financial stress permanently. That is the true cost of debt, not the interest rate, not the monthly payment. The compounded future value of every dollar that leaves your account before it ever had a chance to work for you. This reframe changes everything. When you carry a $12,000 credit card balance, you're not just paying 24% interest annually. You're paying with the investment that money could have become. When you finance a depreciating car for 6 years, you're not just managing a payment. You're trading a portion of your future net worth for a vehicle that loses value the moment you drive it off the lot. Debt is not neutral. It is not simply a tool or a modern convenience. It is a claim on your future income, placed by someone else, before you get to decide anything. Zero debt living isn't about being extreme. It isn't about never borrowing under any circumstance. It's about understanding that every dollar freed from a debt obligation is a dollar that now answers to you, that can be saved, invested, or deployed towards something that actually moves your life forward. That understanding is what separates people who earn decent incomes and still feel stuck from people who earn less and somehow always seem to have options. This leads to the first law. Law 1. Never borrow for anything that loses value. This is the foundational law, the one everything else builds on. And it sounds simple until you realize how aggressively modern consumer culture is designed to make you violate it constantly. Here's the framework. Before taking on any debt, ask one question. Will this asset be worth more or less in 5 years than it is today? If the answer is less, and for most things people finance, it is, then borrowing to acquire it means you're paying interest on something that is simultaneously shrinking in value. You lose on both ends. The math makes this visceral. You finance a $35,000 vehicle at 7% interest over 60 months. Your total repayment comes to approximately $41,400. Meanwhile, that vehicle, which began depreciating the moment you signed, is worth roughly $17,000 by the time you make your final payment. You paid $41,400 for an asset now worth $17,000. The gap between those two numbers, $24,400, is the real price of that transaction. Not the sticker price, not the monthly payment, the gap. Now here's the counterintuitive part that makes this law genuinely powerful. Most people assume this law would eliminate large purchases from their lives entirely. It doesn't. It redirects them. Someone operating under Law 1 who wants a $35,000 vehicle saves aggressively, pays cash for a $14,000 reliable used car in the interim, and reaches their target without financing a depreciating asset. They arrive at the same destination. They just don't hand $24,000 to a lender to get there. The law doesn't shrink your life. It changes the sequence of events. Applied consistently across every major consumer category: vehicles, furniture, electronics, vacations, clothing. This single law eliminates the majority of the debt that keeps middle-income earners financially stuck. Because almost everything people finance falls into the depreciating category. Almost nothing financed at a consumer level appreciates. The exceptions are narrow and specific. A mortgage on a property in a growing market. A student loan that demonstrably increases earning power. Financing equipment directly tied to income generation. Outside those narrow cases, the rule holds without exception. Never borrow for anything that loses value. The person who lives by this law for a decade looks dramatically different from the person who ignored it. Same income, same city, same opportunities. But one of them owns their assets outright, carries no consumer obligations, and keeps every dollar they earn long enough to decide where it goes. The other one is still managing payments. Law 2. Treat your debt payoff like a second income. Most people treat debt elimination as an expense. A bill. Something that leaves the account every month alongside the electricity and the groceries. That framing keeps it small and passive. Reframe it as income generation, because mathematically, that's exactly what it is. Eliminating a $300 monthly debt obligation is identical to receiving a $300 raise. The cash flow impact is the same. The difference is you don't need a promotion to get it. You just need a payoff date. Takeaway: every debt you eliminate is a permanent raise. Chase payoff dates the way ambitious people chase salary increases. Law 3. Never let a month pass without a debt target. Vague intention produces vague results. People who say, "I'm working on my debt," without a specific target, a specific account, and a specific payoff timeline, make almost no measurable progress. People who say, "I am eliminating this $4,200 balance in 7 months," move with precision. Here's the counterintuitive part. The target doesn't have to be the largest debt or the highest interest rate. It has to be specific. Specificity creates momentum. Momentum eliminates debt faster than any interest rate calculation ever will. Takeaway: name the account. Set the date. Work backward from there. Law 4. Build a zero-debt buffer before you invest aggressively. This one creates resistance. Most financial advice tells you to invest early and invest often, and that advice is correct eventually. But investing while carrying high-interest consumer debt is mathematically incoherent. You cannot out-invest 22% credit card interest with market returns averaging 7 to 10%. The counterintuitive truth is that paying off a 22% interest debt is the single highest guaranteed return available to you. No index fund offers that. No savings account touches it. Eliminating high-interest debt, first, isn't conservative. It's the most aggressive wealth-building move available at that stage. Takeaway: pay off high-interest debt before maximizing investment contributions. The math is not close. Here's where most conversations about debt get it wrong. They treat zero-debt living as a financial strategy, a set of tactics, a better way to manage numbers on a spreadsheet. And on the surface, that's what it looks like: smarter decisions, lower obligations, cleaner cash flow. But that's not actually what's happening. What's really happening is a fundamental shift in who controls your time. Debt is not just a financial instrument. It is a claim on your future labor. When you borrow money, you are making a binding agreement to show up to work at whatever job you currently have, under whatever conditions currently exist, until that obligation is satisfied. You don't get to renegotiate. You don't get to pause. You don't get to decide this particular month that you'd rather take a risk, change directions, or walk away from something that's no longer serving you. The lender doesn't care about any of that. The payment is due regardless. This is what people mean when they talk about financial freedom, and most people misunderstand it entirely. Financial freedom is not about being rich. It is not about a specific number in a brokerage account or a house paid off in a prestigious neighborhood. Those things are outcomes. Financial freedom, at its core, is the ability to make decisions about your life based on what you actually want rather than what your debt obligations require. The person carrying $60,000 in consumer debt and earning $90,000 a year is not free. They are employed by their lenders. Every morning they go to work. A significant portion of that labor has already been promised to someone else. Their income is not really their income. It is a pass-through account. The person carrying zero consumer debt and earning $55,000 a year owns their labor completely. Every dollar that arrives belongs to them first. They decide where it goes. They can save aggressively, take a lower-paying job they actually enjoy, absorb an unexpected crisis without catastrophe, or build towards something on their own timeline. Same country, same economy, completely different lives. This is why the laws in this video are not really about debt. They are about sovereignty, about who gets to decide what your income does, about whether your financial life is built on intention or obligation. People who reach zero consumer debt consistently describe the same thing: not excitement about a number, but a profound quiet, a feeling that their life finally belongs to them. That feeling is what you're actually building toward. And the next set of laws will show you exactly how to get there. The first 5 laws were about elimination, identifying debt, understanding its true cost, and building the mindset to remove it permanently. These next laws are different. They are about construction, about building the systems that ensure debt never reclaims the ground you've taken back. Law 6. Automate your freedom before you spend anything. The moment debt is eliminated from a category, that freed cash flow must be redirected immediately and automatically. Not intentionally, not manually, automatically. Because intention without automation collapses the moment life gets busy, stressful, or tempting. The counterintuitive reality is this: people who automate savings the day after eliminating a debt build wealth faster than people with higher incomes who manage money manually. The system removes the decision, and removing the decision removes the failure point. Takeaway: the day a debt dies, an automatic transfer is born. Same amount, new destination. Law 7. Build your emergency fund like a debt you owe yourself. Most people treat emergency savings as optional, something funded with whatever's left after everything else. That framing guarantees it stays underfunded. The people who maintain true financial stability treat their emergency fund as a non-negotiable obligation, identical in seriousness to any monthly payment. 3 to 6 months of expenses, liquid, untouched, not invested, not allocated, sitting in a high-yield savings account doing one job, making sure a crisis never becomes debt. Takeaway: an underfunded emergency fund is a future loan you haven't taken out yet. Law 8. Give every income increase a destination before it arrives. Lifestyle inflation is not a character flaw. It is a design flaw. When income increases without a predetermined plan, consumption expands automatically to absorb it. This is not weakness. It is human nature operating exactly as expected in the absence of structure. The solution is simple, and almost nobody does it. Before a raise takes effect, before a bonus arrives, before a new income stream produces its first dollar, decide where it goes. In writing, specifically, the decision made in advance, in a calm moment, is always better than the decision made in real time when the money is already in the account. Takeaway: unassigned income always finds somewhere to go. Make sure that somewhere is yours. Law 9. Measure your net worth monthly, not your bank balance. Bank balance monitoring creates a false sense of security. A checking account with $4,000 in it looks healthy until you remember the $31,000 in liabilities attached to your name. Net worth, assets minus liabilities, is the only number that tells the complete truth about where you actually stand. Tracking it monthly does something important psychologically. It makes debt feel real in a way that monthly payments never do. Watching your net worth climb as liabilities decrease creates momentum that no budgeting app can replicate. Takeaway: track the number that tells the whole truth. Net worth, monthly, without exception. Law 10. Never return to debt for convenience. This is the law that protects every other law. Because the most dangerous moment in a zero-debt journey is not the beginning, it is after. After the hard work. After the discipline, after the freedom finally arrives. That is precisely when convenience creeps back in. One finance purchase, one balance carried for a month, one payment that seems manageable. The people who stay debt-free treat that status as an identity, not an achievement. Achievements can be undone. Identity guides every decision automatically. Takeaway: zero debt is not a destination you visit. It is a standard you maintain. Everything covered in this video stays theoretical until you attach it to a timeline. So here is exactly where to start. 3 tiers, 3 time frames, 1 specific action each. No vague instructions. No overwhelming lists. Just the next right move at the right time. This week, list every debt you currently carry on a single sheet of paper. Not a spreadsheet. Not a budgeting app. Paper. Write the creditor name, the outstanding balance, the interest rate, and the minimum monthly payment for each obligation. Every single one. Student loans, car notes, credit cards, personal loans, buy now pay later balances, everything. Most people have never seen their complete debt picture in one place simultaneously. That single act, seeing the full number, undivided and unavoidable, changes the psychological relationship with the problem. It moves debt from a vague, uncomfortable feeling to a specific, solvable equation with a finite answer. You cannot build a plan around a feeling. You can build a plan around a number. Do this before the week ends. 1 page. Complete picture. That is the only task. This month, identify your smallest debt balance and calculate the exact date it can be eliminated if you redirect every available dollar above the minimum payments toward it exclusively. This is the first target, not the highest interest rate, not the largest balance, the smallest balance, because elimination creates momentum, and momentum is the resource most people run out of before the strategy is time to work. Find one specific expense in your current budget that can be reduced or removed entirely for the next 90 days and redirect that exact dollar amount toward the target balance. One cut, one redirection. Applied consistently for 90 days, most people are surprised how quickly the first balance disappears. The first payoff is the proof of concept that makes every subsequent payoff feel inevitable. This quarter, open a high-yield savings account, if you don't already have one, and establish an automatic transfer for a fixed amount on every payday directed toward a starter emergency fund. The target for this quarter is 1 month of essential expenses saved and untouched. This single buffer changes everything. It means the next unexpected expense, the car repair, the medical bill, the appliance replacement, does not become new debt. It gets absorbed, and the chain that kept pulling you back to zero gets broken permanently. 1 month of expenses. Automatic. This quarter. The list. The target. The buffer. 3 moves. Execute them in sequence, and you will end this quarter in a measurably different financial position than you started it. You're not following these laws because you hate spending money. You're not doing this because you want to live small, or because you've decided comfort is the enemy, or because some video convinced you that enjoyment is financially irresponsible. None of that is what this is about. You're doing this because you've finally understood something that most people around you will never stop to examine. That debt is not a financial product. It is a transfer of power. And every law in this video is simply a decision, made in advance, made deliberately, to keep that power where it belongs. With you. Think about what that actually means in practice. It means the next time your industry contracts, you are not one of the people lying awake calculating how many missed paychecks stand between you and catastrophe. It means the next time an opportunity appears, a business, an investment, a career pivot, a chance to do something that actually matters to you, you can move toward it instead of watching it pass because your obligations won't allow the risk. It means the next time someone you love needs something, your answer is not determined by a credit card limit. That is what zero-debt living actually produces. Not a number, not a certificate. A life that responds to your decisions instead of your lender's schedule. The people who build this, and they exist at every income level, in every city, in every industry, share one common characteristic. They stopped measuring their financial health by what they could afford to pay monthly and started measuring it by what they actually owned outright. They stopped asking, "Can I manage this payment?" and started asking, "Can I afford this in full? And if not, do I actually need it now?" That shift, from payment thinking to ownership thinking, is the entire game. Everything else is just execution. So here is the question worth sitting with after this video ends. Not, which debt should I pay first? You already know the answer to that. The deeper question is this. Are you managing a financial life built on intention, or are you maintaining a set of obligations that someone else designed for you? Because the laws exist, the framework is clear. The math is not complicated. The only variable that has ever separated the people who get there from the people who stay stuck is whether they decided, genuinely decided, that their income belongs to them first. You now have every reason to make that decision. Make it.